Welcome to the Robert Wenzel Show. Please stand by for Robert Wenzel.
Hello, everyone. Welcome to the Robert Wenzel Show. I'm Robert Wenzel. My guest is Bill Bergman, who worked for the Federal Reserve Bank of Chicago for 13 years. He was a money laundering specialist at the Federal Reserve. He was an economist there and a financial analyst. He raised questions about unusual currency transactions that occurred before 9/11 and ended up without a job at the Federal Reserve. So, Bill, welcome to the show.
Thanks, Bob. I appreciate it. Nice to be here.
Okay, first, am I accurate on that? Were you fired after you raised the questions or released or something like that? How did you end up not working for the Fed anymore?
Well, I guess the chain of events were after raising the questions, a week later, my assignment was terminated in the money laundering area. I was told I'd committed an egregious breach of protocol. And about a month later, my position in the bank was eliminated. At the latter point, I was told that it had nothing to do with me personally. It was an organizational matter.
I'm sure people are not fired from the Federal Reserve very often, especially after being there 15 years or 13 years. So I can imagine what kind of organizational problem that was. But what specifically did you raise? What questions did you have about currency transactions or money laundering that caused them to move you around and eventually eject you?
The two specific areas that I looked at, I was developing. I wasn't quite a money laundering specialist. I had already done a fair amount of work about interbank payments and the plumbing in the financial markets and had a familiarity there. But I was certainly not an expert in the money laundering area when I was asked to work in that area. But I was asked to try to develop a reference document for the Federal Reserve System if it was good. And not knowing much about money laundering, the first thing that I tried to write was a primer for anybody else new to the area. And two of the things that I saw while I was writing this primer and raised questions about were the fact that on August 2nd, 2001, the Board of Governors in Washington issued a non-routine letter to the reserve banks, a supervisory letter urging them to scrutinize suspicious activity reports. The topic of terrorism or its financing were not included in that letter, but they were known to be part of the realm of suspicious activity. And that letter perked my interest up in part because I'd also looked very kind of closely at the monetary aggregates and specifically the currency component of M1 within the monetary aggregates had posted an extraordinarily large increase from June to August 2001, with some very interesting, possible, and perhaps even very important explanations that we have no evidence that they've been investigated. So I'd seen the currency shipments and I'd seen this letter, and I asked a question on a 40-question Q&A, why did the Board of Governors issue this letter on August 2nd, 2001? And it was the only question that I hadn't answered on the Q&A that I developed as part of a primer. And I was asked to go ahead and answer the question, so I called board staff in a relevant area and asked the question. And the conversation was shorter than I expected, and a week later my assignment was terminated. And I lost my credentials for access to confidential information.
Wow. What are your suspicions? What do you think caused the bump in the currency withdrawals?
There are one possibly innocent explanation certainly operating, as well as two very important other explanations. The innocent explanation is the fact that there was a banking crisis flowering in Argentina, and the people withdrawing large amounts of dollars in dollar-denominated accounts in bank accounts in Argentina. And there was certainly an important function there for the role of the dollar in the U.S. currency. Federal Reserve notes, $100 bills specifically, in being shipped to Argentina to meet that demand. But Argentina wasn't just in a banking crisis. It was also in the middle of a money laundering and political crisis with potential links to parties of interest on the other explanations that are operating. Those two are, first, the fact that in a time of war or during a declared national emergency or in any time, certainly, for instance, after 9/11, assets in the banking system and securities accounts can be frozen and seized by the criminal authorities as well as the Department of Justice and the banking regulators. And we did seize assets and freeze assets in the banking system after 9/11. And we certainly learned a great deal more about what we the kind of information that was flowing in financial, not just perhaps in financial markets, but the extent of intelligence warnings in mid-2001 was pretty pervasive regarding the possible events of 9/11. And anyone who knew or suspected that assets were possibly at risk after the events of 9/11 would have an incentive to get out of the banking system and into the underground economy before those events in order to keep their assets from being frozen. So following the money in that regard would help you identify people who had possibly prior knowledge, if not responsibility, for the events of 9/11. And that seemed to be a very, and still very important area of investigation that we have no evidence that there's been an honest investigation of yet. The other area that's also of possible interest and growing on me, but I don't know how probable it is that the use of currency in covert operations in the United States has a long history. And it's possible that accelerated covert operations were already underway in Central Asia in July and August 2001. That's another possibility in my head.
Let's specifically talk about where you saw the jumps in currency. Was it in the Federal Reserve Bank of Chicago? And then I think I saw some data which also indicated out of the Federal Reserve Bank of Boston. Am I correct in that? Or?
Well, among the publicly available data that's out there, three areas that show in the public data, you have the currency component of M1, right, which is publicly reported. And you also have on the board's H41 release, which is a description of the balance sheets at the Federal Reserve banks around the country. You can see the Reserve Bank holdings of currency show a pretty significant decline, billions of dollars, in the months right before 9/11. So that's another source of public data that's out there that indicates something strange was going on. And then finally, another area is the Treasury Department puts out coincident indicators of currency in circulation on a little bit different definition from what the Fed provides. And that shows a big increase in $100 bill circulation in mid-2001. So there are three sources of public information. I can't discuss the things that I saw in the internal data at the Federal Reserve, except I will note that I was doing some double takes when I saw that, and one of the times when I looked back at the data after doing a few double takes, it was no longer freely available in the internal Federal Reserve network where it was previously. It had been password protected, but I can't share what I saw on that score.
Wow, now that's interesting. Now, it should also be made clear, I mean, Bill, is it like fairly easy to trace back and actually find out where this currency went to? I mean, who was withdrawing it from the system and all that?
Yeah, there would be, certainly not just statistical or, we may have had a lack of reporting that we should have had. And in fact, there were subsequent investigations and fines applied to several banking firms, including UBS and Riggs, regarding their failure to file sort of required reports like currency transaction or suspicious activity reports in 2004. It's possible those institutions are worthy of scrutiny on this score, among others. And you could use the paper trail in terms of the reports that were filed, and you can also do some creative work, I think, investigative-wise, even if the reports aren't there. And Congress could do that today with its subpoena authority, but we haven't seen the kind of investigation, I think, that we deserve.
Right. I mean, this is just basic follow the money kind of research that could really answer a lot of questions. I posted it at my site a couple of times. There were some Chicago Board Options Exchange employees that told me that the CBOE had started an investigation into who had bought the put options on airline stocks before 9/11. And of course, those people would have profited because the airline stocks dropped, and put options allow you to benefit from a drop in stock prices. And they told me that government officials went in, met with the president of the CBOE, and told him to stop their investigation, that they were going to continue the investigation. And immediately after that, the data was destroyed. I mean, I don't know if you're familiar with that, but I got this from people that were pretty much in the meetings.
Well, I'm not aware of that specifically, but that's very interesting, and it's consistent with my own concern about the lack of quality in the investigation of the possible informed trading prior to 9/11 in general, and certainly the 9/11 Commission. In reading that treatment of the matter, they apparently washed their hands of the matter way too quickly.
So now, you had specifically raised questions about some of the things in the 9/11 Commission report? What did you raise about what was in there or what you felt was misleading?
There are a number of things I think that there's a wider group of people, especially these, there's a wonderful film out there called 9/11 Press for Truth, which is a documentary about the efforts of the Jersey girls, the 4 or 5 ladies that were responsible, if anybody was, for the formation of the 9/11 Commission in the first place, and their ultimate dissatisfaction or disappointment with the quality of the work of the 9/11 Commission. But regarding what we're talking about, I guess on page 172, there's a statement along the lines of, in the final report of the 9/11 Commission, if I can remember it, it's the note that Al-Qaeda had many sources of financing. The source of the financing for the attacks was of no practical significance, was their wording, or little practical significance. We don't need to follow the money because it's really not that important.
How absurd can you get? I mean, that's outrageous. And that is in the 9/11 Commission report.
On page 172.
Wow. All right. Is there anything else in the report that raised the question with you?
It's been a while since I've thought about this.
Okay.
I'd like to give that question a little further thought before I answer it.
Okay. I've also heard you comment about activity in reinsurance stocks. Can you talk about that and what happened there before 9/11? Sort of give us background on what a reinsurance stock is.
Sure. I guess the insurance world, you and I, as individuals, we buy insurance against dramatic events in our own lives, while insurance companies lay off some of that risk in a wholesale market that's very important and very interesting called the reinsurance market. And there's a lot of money involved. There's big companies absorbing risk in the insurance system for insurance companies that don't want to hold all of the risk themselves. And reinsurance companies took significant losses on the events of 9/11. For instance, Munich Re, Swiss Re, AXA did some reinsurance business there, and those stocks were all very, very weak in the weeks before 9/11. And that's another area that we didn't see a great deal of thorough investigative work, I think, so far by our official governmental authorities.
Bill, it's important to really point out, I mean, this is not stuff that could not be checked. I mean, it can be checked where that currency went, who withdrew it from the banks and why, who bought the put options, why they bought the put options, and who was selling or shorting these reinsurance stocks. I mean, there's a lot of things that basic investigation could tell us a lot and not being done for some reason. And you're the guy that seems to be from the inside that was doing the closest investigation along these lines. And you got moved out of that department, and then you got moved out of the Fed completely after being there 13 years. So it raises many, many concerns as far as...
I think you're right, Bob. I think basic is another good word you used there. Fundamental questions that, granted it's been a long time, but I think the answers are still available if we really honestly tried to search for them. I'd also like to note, if I could, that, I was already in hot water for some other things. I think you would appreciate giving your perspective on central banking and the questions that I'd raised in financial market policy and in other regards. And that was part of my departure, I suspect.
Mm-hmm. Do you want to talk at all about that, or?
Sure. I guess one that's just kind of very, curious was in 2003, I developed, not to pound my chest or anything, but I think it was important. I developed a proposal to strip references to credit ratings out of capital regulation. I was concerned that we were outsourcing our own responsibility for capital regulation to the credit rating agencies in ways that would end up, we would regret. If the ratings were inflating things, then we wouldn't have the capital we thought we had in the capital regulation. A simple insight, I think, but I think it was kind of central to the meltdown in light of what happened. Another project that was very interesting. There's a very interesting role in the Fed. We think of the Fed as, the first thing that comes to mind is monetary policy. People also are aware that the Federal Reserve supervises and regulates banks. But another very important leg of the stool in the Federal Reserve operation are the interbank payments operations at the Federal Reserve. The plumbing of the financial world there's a big dollar amount involved here too. The Federal Reserve's FedWire system, you and I use banks to pay each other money, but the Federal Reserve provides services to banks that allow them to pay each other money. A wholesale payment system. And there's a payment system called FedWire that moves over $1 trillion in between the banks every day. And in the late 1990s, to make a longer story short, there was a set of testimony from members of the Board of Governors to Congress that were raising questions about the Fed's own compliance with something called the Monetary Control Act, and specifically within the Monetary Control Act, the cost recovery provisions that theoretically provide protection that the Federal Reserve will not subsidize the payment services it provides to banks. And anyway, I raised questions about our accounting for FedWire, and that was the beginning of the end for me at the Fed. That was a couple of years before the money laundering area episode.
You know, one other question, this may not be something you're familiar with, but how well prepared are the Federal Reserve banks in case there was ever any kind of dramatic bank run demanding cash out of the system? And the reason I ask this is many, many years ago, there was a bank run in a small bank in Chinatown, and there was the obligatory picture in the New York Post, I think, showing the lines and people bringing out lounge chairs and things like that, waiting for the money. And it just sort of struck me as odd as to why people would have to be waiting in lounge chairs. I mean, you just go in, you write a golf slip or whatever and pull your money out. And I called the branch manager of that bank in Chinatown, and she told me the Fed officials, I believe she was probably talking about FDIC officials, came in and told her that there was not enough money available to withdraw everybody's money right away, so make them fill out all forms in detail, go over slowly, carefully, and all that kind of thing, and take your time about it, and make sure they cross all their T's and dot all their I's, sort of stalling the withdrawals. And then when you had the most recent crisis here with regard to the subprime, and there was a problem with one of the countrywide banks on the West Coast, you know, those same lines appeared again with people in lounge chairs and things like that waiting for their money. So there seems to be some kind of modus operandi when people attempt to draw out their money, that the federal authorities are in some way going to slow that down. Do you have any thoughts on that? Or
I think the possibility that we've seen, that raises another set of important questions. But in terms of the response to the subprime crisis and the related financial crisis more generally in recent years, I think our government has bent over backwards to be very protective of depositors, and that has another set of consequences that are certainly problematic. But
right.
The possibility of what you're talking about is something that's been, if anything, we've bent over backwards to stop that from happening. So I don't think that's a likely outcome. Having said that, the Federal Reserve banks have billions of dollars of $100 bills in their basements. And I don't know how big the deposit run has to be, but I don't think it's that likely in light of the protection measures that we've taken to shore up otherwise unhealthy banks. And now that raises another set of important questions about moral hazard and why we're doing this, why we're socializing risk in our banking system, which is a bigger issue, I think.
On another topic, I see where you were involved in writing. You were a contributor to the Beige Book out of Chicago. Can you talk a little bit about what the Beige Book is and how accurate do you think it is and how important it is and things along those lines?
Well, sure. That was my first job at the Fed in the first 5 years or so, was writing the Chicago Fed's contribution to the Beige Book. That's every 6 weeks, each of the Federal Reserve banks puts together a 3 to 4 page description of economic events in the previous 6 weeks, based largely on anecdotal evidence, talking to businesses. And it's not perfect by any stretch, but it is an important supplement to making decisions in the interim. Whether or not we should have a central bank making decisions that it's taking is another question. But as long as we do, given the ambiguity and the lag in the economic data that we have, it's an important. Warren Buffett has a Rolodex that's unparalleled in talking to people that have up to the minute information about economic trends in housing and heavy manufacturing. Talking to real business people about current conditions in their marketplace is an important supplement to the economic data in interpreting current economic growth. And that's what the Beige Book tried to provide, was in talking to real people about conditions in their marketplace. Temporary help companies, appliance manufacturers, automakers. You got to be careful because it's not a large sample. It's not a statistically perfect sample or anything, but getting good judgment from people that you trust on a regular basis will help.
Yeah. Now, Bill, that's interesting. So does Omaha fall under the Chicago region, and would Buffett be one of the people you're talking to when you put that?
No, Omaha, I think that would be a Kansas City Fed sort of operate. And even there, it's kind of hard for the Beige Book level people to talk to Warren Buffett by any stretch. But, we did have significant people in the automakers and the big temporary help companies. Manpower was a temporary help company in Wisconsin. And I'd pull out yellow pages at random and And again, you got to be careful because it's not a big sample, but talking to local auto dealers in Peoria and just, getting a pulse of the people out in Main Street was one part of that picture.
Yeah. Now, you mentioned Manpower. That's interesting. Did you have favorite types of companies or industries that you tried to look at? I mean, Manpower is great because it sort of gives you a spectrum of what's going on with employment or temporary employment type thing. I mean, were there others that you had that were kind of your favorites or something that people wouldn't ordinarily think of as
well, Manpower Kelly Services is another Midwest-based organization. The appliance manufacturers, that's an important area, is very cyclically sensitive, and we had some contacts there. Inland Steel, there was a wonderful economist executive there, Bernie Lashinsky. He was a fun guy to talk to about conditions in steel markets. And we had some other unique sort of contacts that we didn't identify by name. Some good housing people, a great realtor, an old school realtor in the Chicago area. John Baird was a wonderful person. Getting his take on housing markets was always helpful.
And would you say pretty much all the Federal Reserve districts compile data the same way, reaching out to people like that, or?
Yeah, it was generally done that way, along with some survey-based information. For instance, the local purchasing manager surveys would be part of the picture in the Beige Book as well.
I noticed somewhere in your comments that you mentioned that Chicago seems to be a hub for money laundering. Why do you think that's so? Or is that so, and why do you think so?
Did I say that? I'm not sure I did.
Yeah, or, I think actually it was a radio show I heard, and maybe it was the host that said that, and then you commented beyond that.
I believe that was Peter B. Collins, who was interviewing me for Boiling Frogs Post. That interview was a good one, an interesting one. Historically, Chicago has a reputation for being the city that works, and the word corruption has been applied to events in Chicago historically and even on a regular basis in recent years. And the way I'm bringing this up now in part because Peter B. Collins was doing that podcast for a wonderful woman named Sibel Edmonds, who has a interesting memoir out now called Classified Woman. And that's her, because Sibel was a person who was hired by the FBI as a translator soon after 9/11 and saw some things that raised very important questions in her mind, not just about intelligence warnings prior to 9/11, but significant corruption and bribery with roots in a Chicago operation that she describes in her book. So that's possibly the context within which someone else described Chicago as a hotbed of money laundering activity.
Okay. There's a lot of money being put into excess reserves at the Federal Reserve these days, over $1 trillion. Do you have any insight or thought into why that's occurring, or if there are any dangers by that occurring, or is that something you're not following at all?
Well, I have looked at it. In fact, it's spiked dramatically in recent years. Anyone who can go to the St. Louis Fed's website and look at the FRED database and go, search on excess reserves and take a look at that picture, and it's dramatic. Now, what's going on there? That's a very interesting question. I mean, in theory, if it's potentially a threat to rising inflation, unless the Federal Reserve is able to offset it with monetary policy adroitly in the event of a rising inflation threat. But more fundamentally, I think it's very interesting in light of remember we talked about FedWire? Mm-hmm. FedWire is it moves $1 trillion a day in part on the basis historically on large amounts of daylight overdraft credit the Federal Reserve extended to the banks, the big banks. At its peak, daylight overdraft credit was well over $200 billion every day on FedWire. And that exposed Federal Reserve banks to a significant amount of credit risk that was very at very low prices, shall we say. That was part of the subsidy. Well, the Federal Reserve, in conducting monetary policy, ended up, with the financial crisis, ended up bolstering the banks in part by the huge expansion in its balance sheet, and by buying securities and that expansion in the Federal Reserve's balance sheet, it contributed to the amount of money and excess reserves in the banking system, which in turn, the banking system is no longer relying on the daylight overdrafts as a source of funding like they were because of the excess reserves that are out there. This is interesting in one respect that, the Federal Reserve banks are no longer exposed like they were to the risk of failure on the daylight overdrafts in the event of a large bank failure. But on the other hand, this isn't riskless from the point of view of the Federal Reserve banks because the expansion in the balance sheet has exposed them to risk in other ways, including the risk that the securities that they purchased go down in price, which could happen in the event of an inflationary outbreak or declining credit quality for a lot of the mortgage-backed securities that are out there.
Do you have any thoughts on the so-called LIBOR scandal? My view has been that it's sort of overblown relative to what a Bank of England or a Federal Reserve can do as far as manipulating interest rates. Do you have any thoughts on what's going on with the LIBOR?
Yeah, I've seen your stuff, and it's checked my enthusiasm for the issue after thinking about the questions that you've raised. I still think the dust has to settle here. We have more to learn. I still remember the day when I was at the Fed and people were calling LIBOR a market rate, and I took a look at how it was constructed. And wait a minute, we shouldn't be calling this a market rate. This is a survey. This isn't. It's kind of like make-believe interest rates. And I think we have more to learn, and the investigations may help point in that direction, as long as they're not corrupted by the kind of influences that you've discussed.
Would you agree? So far, what we've seen is to the degree it's been manipulated. I put a chart showing it in relation to Treasury bills and Fed funds rate, and they seem to move in general same directions on an almost daily basis. But to the degree that they could have been manipulated at all, it seems that they were attempting to manipulate to the downside, which would have benefited all borrowers that have a rate based off of LIBOR somewhere. So it's not like this was a scandal somehow where these bankers were propping up the rate to try and earn more money or anything. I mean, if anything, it was going in the opposite direction.
Well, certainly during the crisis, the incentives are what you described. I mean, banks don't want to report that they're being forced to pay high LIBOR rates because that means that other banks don't have confidence in their credit quality. So, in fact, if anything, especially during 2008, there might have been an incentive to underreport, not overreport LIBOR. But again, I think we have more to learn from investigations.
You have the 16 banks there. It's hard to think that they would all have their balance sheets positioned so that they would all sort of benefit from an interest rate going in the same direction. So it's hard to see complete collusion there because some guys might benefit from, might be short the interest rate in one way or the other and others be long. And if everybody sort of got on the same side, that would be a huge signal to the markets. And I just don't see how it could have been done from that. Do you have any thoughts on that or?
Well, just reacting to you, I'm respectful of the University of Chicago's take on antitrust policy and the respect that market incentives can often check the ability of collusion to persist. Collusion is very difficult to achieve in practice, and competition can erode that. It'd be very difficult to do this for 16 banks at once. Having said that, it isn't impossible, and I still think we have more to learn. And it's worth learning given the dollar amounts involved, the trillions of dollars of contracts that are based on LIBOR. It's a little strange that the LIBOR is a survey-based, not market-based rate, and it provides some scope for manipulation. So, I think I'd like to check any conclusions I have until we see more. If we ever do see honest investigations, I've lost hope that our own Department of Justice actually pursues justice.
Rupert Murdoch has raised the question that this might have started as an attempt to shoot down Barclays a little bit because they were more aggressive than the other banks in London. I don't know if you have any thoughts on that, but that's an interesting take from Murdoch coming out of, given that he didn't have to comment on it at all.
I guess that's one speculation, and sometimes that's how competition works. Right. But I don't know if that's a fact or not. Okay,
Bill, thank you very much. Good luck. Are there any projects you're working on now that you want to talk about or anything like that? Or what are you doing these days?
I'm working on a couple of things. I'm teaching a money and banking course at Benedictine and Benedictine University in the Chicago area, and I'm also working on two startup efforts. One is an effort to develop evaluation systems for not-for-profit organizations, and we've developed a fund called the Liberty Markets Fund for Freedom, which is basing its funding down the road. We'll be basing our funding decisions on the evaluations of 40 free market public policy think tanks around the country in this fund called the Liberty Markets Fund for Freedom. And the other group that I've been working with is a group called the Institute for Truth in Accounting, which is a Chicago-based effort that's looking more fundamentally right now at state government budget and financial reporting and for instance, the pension and other possible problems with presenting a true picture of state government budget situations.
Okay, good luck with those projects. It sounds like the Fed has not slowed you down. Thank you, everyone, for listening. This is Robert Wenzel. Be sure to check out my website where I blog every day, all day long, about the markets, about the economy, about liberty. It's economicpolicyjournal.com. It's economicpolicyjournal.com. Special shout out to Chris Rossini, executive producer of the show. Thank you very much for listening. There'll be a new show up on Sunday where I posted at economicpolicyjournal.com. Thank you for listening.